So we had to talk about the May numbers from the May market in Wellington region, of course. Headlines is it's the same pattern continuing on, really same trend. Values are still falling, well, they have been still falling. More supply than we've seen for many years. And again, my message to buyers is to encourage you to get out there. If you are anyone who's buyers, I mean, especially if you're looking for a home, these are the best conditions we've had for ages. And of course, for the most part, what buyers are concerned about now is if I buy now, whereas before they were worried about if I don't buy now, I'll look like a fool in 3 months' time because I should have bought because prices are higher and I end up paying more. What they're worried about now is that I'll look like a fool if I buy now instead of waiting. So if I buy now, then in 3 months, maybe I'll look like a fool. So I should wait. The trap then, of course, is you only get in once you know the bottom is passed, and by that point there's more competition and prices are rising again, and it's much more difficult to get as many of those boxes ticked. Whereas now you can really be much more choosy and pursue the properties that meet all your objectives or more of your objectives, and rather than worry about am I going to miss out on a further 2 or a 4 or a 6% drop. I think ultimately in the long term, the bigger picture is getting a house that works for you and your family. It's going to serve your needs for a long period of time. That's more important than worrying about another 2 or a 4 or 6%. We've already fallen by quite a bit. You're already way better off than those who bought back in September, October, November, December. So yeah, just getting amongst it. Anyway, like I say, just jump on in if you want to ask anything or whatever, have a chat. Let's get into this. So median sale prices, 895,200 in May this year versus 885 1 year ago, up by 1%. So let's call it flat. So if you see here the graphs, the blue chart, of course, is the monthly results. So really interesting pattern we've seen over the last 18 months or so. From early, excuse me, I'll just let someone else in. From early in 2021, throughout a lot of 2021, we saw median prices sort of high 800s. Excuse me again, more people in the waiting room. Median prices in the high 800s, early 900s. And then sort of end of last year or late last year, we bumped right up to high 900s. And at one point, we almost touched 1 million. And then the last 3 months, you can see we've dropped back down to more like where we were, you know, kind of for a lot of 2021. And that's indeed shown in the in this result here, 885 only going up 1% to 895. As you know, or if you've been on some of these calls, I don't like the median house price as a real guide into what are the underlying values, because of course it's deeply influenced by the mix of properties that are sold rather than the actual underlying value changes. So let's look at the Real Estate Institute House Price Index. And what this shows is a more stark picture, really, and that is that, and you see there in Wellington, in May, underlying values fell by nearly 3%. That's a big drop for 1 month. And over the last 3 months, nearly 10%. So this is again, it's a big drop. And if we look at the last 12 months, even down compared to 12 months ago. So have a think about that. What that means is, whatever values we were at 12 months ago, if we did have value increases since 12 months ago, albeit pretty gradual, all of those values have eroded and we've dropped by a further 6.9%. This, of course, is the Wellington region. If you look at New Zealand, down by 1.6% in the 1 month, 5.6 in 3 months, still up nearly 4% compared to a year ago, though. So Wellington, you'll remember Wellington as we came out of lockdown. For some reason, the Wellington market rocketed up sooner and faster and further than most of the rest of the country. And we are seeing the opposite happen on the other side. So as the market has stalled, as the peak has been reached, Wellington seems to have been one of the first parts of the country, and certainly the first main centre, to start actually reducing, and it has been reducing steeper. I guess it stands to reason we have never seen such ridiculous price rises as we saw in the sort of 15 to 18 months post-COVID. And so these falls we're seeing now, 9.7% in the last 3 months only in Wellington. That's about as far as the market fell from peak to absolute trough as we came into the GFC. And that's just been in the last 3 months. So whereas in the GFC, if I remember rightly, it took something like 12 months or 15 months to actually fall that roughly 10% that we saw. Anyway, Wellington certainly has been earliest and steepest, and seems to be falling further than most of the rest of the country. Interesting also, you see there the different parts of Wellington: Pororua, Upper Hutt, Lower Hutt, Wellington City, of course. So the city itself, 11% down in the last 3 months. These are big drops. So let's look at the a bit of analysis of the history of the house price index since early 2021. So yeah, we came out of these big rises in early 2021, but as you can see there from that blue line, from March of last year right through to about October, November time, we were only seeing 1 or 2% value growth in Wellington region per month. And yet all the numbers that were coming out in the papers and in the media and so on was still saying Wellington prices are skyrocketing. That is because they always look at the 12-month result. And so, yes, the 12-month result was still really, really high. But actually, if you looked in the right places, you can see there that the monthly house price index was actually only just growing. So we could see this slowdown coming. Really, it started back in March of last year, but it really wasn't in the media until, I would guess, what was it, March this year. So they was a bit slow to grab onto that. And as you can see in this little starburst here, this is looking at the last 3 months and the last 12 months. What I did is I charted these numbers to see, well, when was the actual peak? The peak was at in the month of October. So if we take the end of October through to where we are now, we're down 12.99% in the Wellington region since the end of October, and 13.8% in Wellington City. So again, the Wellington City has been fastest and furthest to fall in the Wellington region, but it's not too dissimilar, 13 versus 14% broadly. But again, you know, this is quite considerable falls since the peak. So 13 to 14% in Wellington. So it certainly has been a considerable slowdown. It's taken most people by surprise. You know, agents, buyers, sellers. I suppose the people who are most upset about it are those people who bought in October and November, but the people who are most really, really impacted by this quick turnaround, of course, are the people who followed the practice of buying and selling that was very, very popular for quite some time as the market was so strong. I'll just let a few more people in, excuse me. For some time, while the market was so very, very strong, very, very difficult to purchase property, the common practice was to buy property first and then sell. People were terrified that if they sold, they would then be unable to purchase something else, then they would be stuck out of the market. And I did hear horror stories of people who sold a property, couldn't get back into the market for 12 months and ended up paying a very similar price for the property as they sold their property for a vastly inferior property, or a much bigger price that they were hoping to upgrade with, and they ended up with just purchasing a very similar property back again and owing just hundreds of thousands of dollars more. So that was, you know, that's profoundly distressing, and so most people decided to avoid that risk, and they would buy first and then sell, knowing that it was very, very easy to sell, and a lot of the time people would do very well out of that, because as the market continued to grow, they would purchase, then the value of their house would increase by 50,000 or 100,000 by the time they sold. However, when it turned, those people engaging that strategy was very, very painful. They would buy a property at the peak of the market, then they get their place ready to put it on the market, and by the time it's sold 3 months later, it had dropped in value by 100,000, 200,000. I mean, if you've got a $2 million property, a 14% drop, that's 280,000. That's a lot of cash to swallow, or that's a lot of debt to swallow. So, those are the ones who are really, really going to be, enduring a bit of pain at the moment. So that's the house price index. So, yep, quite considerable falls in value, even though the actual median house price is broadly flat compared to a year ago. So let's move on. And this is really an interesting bit of analysis that Tony Alexander puts out periodically. Any of you out there who subscribe to his premium newsletter will get this every once in a while. Is it every month, or maybe it's every week? I can't recall. He will really deep dive into the values of real estate in a particular part of the country. And this is pulled from the Lower North Island analysis, where Wellington and its surrounding sort of areas are analysed. And what these graphs look at is it's really looking at the relative value of the real estate in the particular location compared to the normal long-term trend of where values sit in that area as a function or as a ratio of the country on the whole. So, for example, to clarify, this first graph here is the Horowhenua district, live-in and surrounds. The black line, what that black line shows is the long-term trend as to what are the average values of properties in Horowhenua compared to the average values in New Zealand as a whole. And what this is saying is, back in 1993, Horowhenua values were on average 1.1 times the national average prices. And more recently, that has dropped, but only ever so slightly, to a little less than 1.1. Now, over the time, it's never actually spot on. It's either above trend or below trend. So you see, it started out in the 90s way above trend, and then it came down, and as often happens in cycles, it goes below trend, and then it was below trend for a bit, then it was above trend, then it came down below trend in the last sort of slow period between 2010 and 2016, 17, and so on. Then it was a whole lot of catch up. In the last few years, it's spiked way above trend there. So you can see there that it started to turn, and indeed the Horowhenua market, if you look at it, it's massively oversupplied. I think the New Zealand average is something like 80% more supply than we had a year ago. Wellington region is about 160% more supply than we had a year ago. So we are way more oversupplied than the country overall. And Horowhenua is very similar to Wellington. If I remember rightly, it's even more oversupplied than Wellington. So that sort of indicates where it's likely to go. And you'll see there that it's only just started to turn, though. And whereas the normal trend would be for it to be a little less than 1.1 times the average New Zealand value, at the moment it's 1.4. So that would suggest that the properties in Horowhenua are highly susceptible, or more susceptible, to properties around New Zealand overall to price falls. It doesn't mean that it's going to fall necessarily, or that it's going to go straight back to zero. And it doesn't mean, if it does, it doesn't mean it's going to stop there. It can go down below, as you can see here. And then we see the same graphs for Lower Hutt. So again, you can see Lower Hutt has recently shot way above its long-term trend. It has turned more so than we saw in Horowhenua. So it has started to fall there, but it's still considerably above trend by about 15% or so. What about Kapiti? Kapiti, you see there, it's also turned. It started to fall, come back towards its normal long-term trend, still a long way above, though, by, again, probably by the look of things, roughly 15% or so. And if you dive into this analysis of Tony Alexander's, and thanks, Tony, for your amazing analysis, all areas around that Lower North Island part of the country, around Wellington, are following a similar sort of a pattern. You have to go right down to the South Island to see places that are below value. For the most part, the North Island is all well above value. Obviously, a bunch of the country has to be above, and a bunch of the country has to be below. But anyhow, what about the last graph? And this is Wellington City. So this is not Lower Hutt, this is not Upper Hutt, it's not Kapiti, it's not Pororua, it's not the Wairarapa, it's not Horowhenua, this is Wellington City. And you'll see there that, you know, for that, during that slow period after the GFC, Wellington City prices were really depressed compared to their long-term average as a relative value compared to the rest of the country. And we didn't reach sort of normal relative value compared to the rest of the country until like 2019. And we saw incredible price growth, but the whole country was growing in price enormously. And so compared to the country overall, our prices in Wellington City itself, downtown Wellington, proper Wellington City, haven't actually blown out of proportion nearly to the same degree as we've seen in the Hutt, in Kapiti, in Wairarapa, and so on. And I mean, why is that? Well, part of it is, a decent chunk of it, I believe, has to do with COVID in that it's done two things. One is it had people focus on lifestyle much more. People didn't have to be in the office as much. And so they went and bought their dream house in Greytown with a lap pool and a little miniature olive grove. And the number of people, the number of buyers for that sort of property went from a handful, 2 or 3 or whatever it might be, and instead of increasing by 50%, which we might have seen in the city, it's increased by 1,000%, because you only need a relatively small number of people from Wellington City to be looking out in the Wairarapa for that sort of property. So those sorts of locations, because of buyers' desire for lifestyle, gardens, bigger properties, and so on, and they're not having to be in the office and in the city so much, therefore commuting was not such a problem. The demand for those sorts of properties and those sorts of locations absolutely skyrocketed. The other thing, of course, is it does is that, you know, you've all heard of the Great Resignation. So buyers were deciding, or people were deciding, oh, you know, that's it, I'm just going to retire early. I'm going to resign. I'm going to retire. So it accelerated, you know, 2 or 3 or 4 years worth of retirement plans into a shorter period of time. And so the demand for the retirement properties was compressed from 3 years or 4 years or whatever it might be into 12 months or 18 months or so on. And so all of that, and most of that demand came out, of course, from the city. And so we saw, relatively speaking, the demand spike in the more provincial locations, further away locations, lifestyle locations, compared to the city, where, relatively speaking, it was compressed a bit. And this is clear to see in these graphs. So anyway, I put this in here to give those of you who are invested in real estate in Wellington City maybe a bit more comfort to think that actually Wellington City prices now are completely on trend compared to where they are on a long-term average basis relative to the rest of the country. Now, if values in the country fall, then obviously our relative position in that scale of things will also, the values will fall too. But we are far less susceptible, according to this analysis, to big price falls in the city than we are compared to Kapiti, Horowhenua, and Lower Hutt. And this is just 3 examples of similar graphs that he's done the same thing for Upper Hutt, South Wairarapa, Carterton, Masterton, and so on and on it goes. So I thought that was quite interesting, and might give you some, if you're invested in Wellington City real estate, I don't know, some hope. It's not all doom and gloom out there. All right, moving on. So yeah, Wellington City, least susceptible to big value drops from here. Looking now at number of new listings. This is the supply side, of course. So May this year, 675, excuse me, just let someone else in. 675 in May compared to 622 in May a year ago and 548 May 2020. So look, May 2020 was a bit of a strange time. We were just coming out of lockdown. Perhaps we should not pay too much attention to that. But compared to a year ago, we've seen a little increase in supply, 9% more than a year ago. And again, look at these patterns. The blue chart shows the monthly results, the easier to see the trend with the red line. And the red line, of course, is the 6-month moving average. Look here, the whole time between early 2015 and early 2022, so 7 years worth of numbers here, the red line pretty much always is bouncing between an average of 600 to 800 new listings a month. We tend to get more new listings in the spring and the summer months, with a hiatus in December and the first half of January, than we do in the winter months. So we tend to get a bit of a swell in the summer and a bit of a lull in the winter, but it bounces between 600 and 800 normally. If we see here, recently we've seen new listings definitely have been on the rise as we came sort of out of we came out of lockdown and came down during lockdown. Then since lockdown, they've kind of been on the rise, and lately we've seen drops again. But this, I believe, this is just the winter effect, because if we compare it to last winter, we're actually up. We're up 9% compared to last May. If we look through the pattern of these graphs here, you see, look, there's May, June, July in 2019. We'll ignore 2020. That was a funny time. There's May, June, July 2020. So at this time of the year, new listing volumes are always falling. But we're still up compared to the same time last year. So we are seeing a little bit more a few more listings come on than normal, but not massively more. You'll see there the red line, it did peak just over 800. That is unusual. That is a lot of listings. And indeed, way back there in 2000, and as we came out of lockdown 2020, that's when we saw the fewest listings, of course, because no one could transact. So yeah, we have seen more listings coming onto the market lately, but it hasn't been this massive rush of people panicking and wanting to get out of the market. It's been a gentle increase. A year ago, the predictions were all investors were going to get out of the market. All investors are going to ditch their properties. It hasn't happened. We're not seeing people who are under massive pressure having lost their jobs, because people haven't lost their jobs. Unemployment is at record lows. So yeah, I suppose that's a long verbose way of saying we are seeing a bit of an increase in listing volumes, but not this huge rush for people trying to sell. On the other hand, the number of sales has taken a big dive, and you see there with the red line again, we saw the number of sales booming out of lockdown, and then since sort of late 2020, we have seen a gradual and consistent downward movement in the number of sales taking place, and it has been particularly steep as we've come into 2022. So similarly with the number of new listings that have come on, well, let's look at the numbers. It's 517 in May this year versus 735 a year ago. That's a drop of 30%. Unlike the new listings, similar to the new listings rather, we saw numbers bouncing around a certain number. Similarly with number of sales, we tend to see them bounce between 600 and 800 on average a month. The only time we have fallen below 600 since I've started collecting this data 7 years ago was when the market was closed during lockdown. And now we are even lower than that. So on average, 524 a month over the last 6 months, and that is lower than we saw even during the 6 months that incorporated the 5 or 6 weeks or so that we were when the market was closed. So it's pretty remarkable that we're selling this small number of properties. It really takes very, very tough market conditions to get down to this low. So whereas we've seen only a small number of new listings come on, there's no rush of vendors desperately trying to offload their properties. There is definitely a slowdown in the number of sales taking place, and that is not because there's nothing to buy out there. It is because buyers either don't want to transact or are not able to transact. And I would suggest both are happening. Excuse me, got people waiting in the waiting room again. For those of you who've sort of joined before, since I started, I really apologize for the fact that we were so late with this one. I had a Zoom login disaster thanks to very secure two-factor authentication. with the access code being emailed to an email, which I had no access to, and the person who does have access to it was driving, and I couldn't reach her, and so on. But anyway, I apologize. And obviously, for the bits you miss, for having come on the call late, obviously you can catch up with the recording if you want to. I'm also happy to take calls or whatever. If you want to give me a ring and have got particular questions or whatever, then by all means do so. So anyway, we're talking about number of sales. So we've had a big drop. We've had a small increase in number of listings come on, but a really big drop. And the big drop will be because you got buyers who can't transact, and you got buyers who don't want to transact. They're afraid, and both are happening. So the Triple Cfa rules really have crushed first home buyers, and investors have been out of the market for some time. And then you have a bunch of people who are just frozen in fear. They see prices falling, and they're terrified that if they buy now, they'll look like an idiot in 3 months because they could have bought cheaper, or they're not worried about looking a fool. They're just terrified of losing all their equity because they've took so long to save up, and they're worried that they'll lose it all. But of course, trying to time the bottom of the market is an absolute fool's game. No one can ever do it, or hardly anyone anyway. Anyway, so on to the next one. Days to sell. How long is it taking to sell in Wellington? It's taking a long time, and you can see again from that red line, it's really increased very sharply over the last 6-9 months in particular. So 55 days in May 2022 versus 24 a year ago, and this is interesting, 55 2 years ago. But of course, 2 years ago, what was happening? We were just coming out of lockdown. So the only other time we've had properties taking this long to sell in Wellington was when the market was literally closed, and that does kind of express how extreme this is. 55 days really is a long time. So you can see again, for the most part in Wellington here, we're seeing things take between 25 days and kind of 35, I suppose, for the most of it. That red line there, it really goes above 35 days, and it almost never goes down below 25 days. And now we're up at 55 days, and on average over the last 6 months, 46. So that sure is a long time. And I think, if I remember rightly, if you dig further into the detail of this, Wellington City was even longer than 55 days. So ordinarily, the city is a stronger market and the lower risk market. And indeed, if you look at that price analysis from Tony Alexander, that would suggest that still is the case. There's less likely to have serious falls from where we are now than the other parts of the Wellington region. But the Wellington City has been taking longer to sell than the rest of the Wellington region, because I think it was 60 days. Again, of course, with a smaller sample size, you do get it bouncing around a bit more. But anyway, it's taking a long time. Now, all of this kind of looks like bad news for vendors, and you could hardly say it was great news for vendors. Of course, if you are selling and you're trading up, you are a net investor in real estate. You're selling $1 million property, buying a $1.5 million property, you are a net $500,000 investor. When the market falls, that $500,000 compresses. And so if you are a net investor, you are better off in the market with the market falling or the market becoming cheaper. If you are a net divestor, you are better off with the market being bloated, because of course you're going the other way around. So if you're investing, prices reducing are good. Psychologically difficult to deal with, psychologically scary, but if you look at it from that pure and analytical basis, if you're a net investor, lower prices are better for you. So that's how long it takes to sell. Inventory. So again, we've seen a couple of months with really quite high inventory, 21 weeks worth of inventory in April and 20 weeks worth of inventory in May versus 5 weeks in May a year ago. I mean, what an extreme turnaround. You see here from, as we came out of lockdown, from, what is that, August 2020 through to December 2021, we were between 4 weeks and 7 weeks worth of inventory on the market for a really sustained period of time. Since December 2021, so basically since January 2022, we have seen inventory just rocket in a small number of months. So as you can see here, we have never, since I started collecting this data, seen inventory levels of 20 and 21 weeks. Now, that has happened. We have seen it because in 2015, the supply in the market was getting soaked up, and we were just getting ready to start the next boom. So it'll be interesting to see where we get back to. I remember way back here in 2015, when the numbers came out, the long-term average amount of inventory for Wellington City was something like 20 weeks. So on that basis, we are actually up to our kind of what was normal coming out of the slow period. But that, of course, was normal for a slow period. The normal for this booming period has been more like 6, 7, 8 weeks worth of inventory, and we're certainly now blowing that out of the water. Number of Trade Me listings. You see the blue charts there. The number of Trade Me listings is actually now reducing. This does not mean that the market is tightening. It's just a seasonal effect. There are typically fewer listings coming on in winter, and then some stock gets absorbed, and so those listings come off Trade Me. But we're still way up compared to a year ago, more so than as a function of 12 months prior. We are now 161% higher than 12 months ago, and sort of in the last 3 to 6 months, it has never been that high. We have been up to about 150 or so. It's never been higher than 160. So on that seasonal basis, it's as extreme as it's ever been during this growth phase. So 28, these numbers were as of a week ago, so they will now be slightly out of date. And compared to the same time last year, 1,085, 161% increase. So that means for every 10 listings that were on the market same time last year, we've now got 26. So if any buyers out there complain that there's nothing to choose, there's not enough stock out there, just give them a little punch in the nose, bring them back down to earth. Yeah, it'll be very interesting to see how the next few months go. Of course, this typical winter time, and then often the supply starts to increase again as we come into sort of September. It can be from late August, but it very rarely is it before September. So it'll be interesting to see how the balance between supply and demand, new supply coming on and sales taking place. Sometimes some buyers who aren't actually motivated to transact, now they have the ability to wait. They sometimes wait for the spring rush to come on so that they've got more to choose from, but now they've got plenty to choose from. The buyers, of course, who are in the market and they have some external factor pushing them into the market, whether it be illness or death in the family or separation or new family members or kids leaving home, downsizing, a new job, these sorts of things, those people are in the market sort of year round. So yep, trade more listings than any other June since 2015. So in summary, folks, we got median prices and values falling. Actually, median prices are about the same as they were 12 months ago, but in the intervening period, of course, they went up and have come back down again. Values definitely falling. Values down 13% since the peak, which was October last year. New listings are up, but up by a bit, not massively up. There is no mass exodus out of the property market. There is not a whole pile of people desperate to sell and rushing to the market. Sales volumes are down significantly though. So while supply has not increased significantly, sales volumes have decreased significantly. Duration to sell up really significantly. Inventory very, very high, 300% higher than a year ago. More Trade Me listings than we've seen since 2015. So yeah, if you are buyers out there, don't wait. I know it's kind of terrifying, but I would really strongly encourage you to wait, not to wait, and get in amongst it and just buy the best property you can that's going to suit you for a long time. Now, a lot of buyers, of course, will not do that. They will sit in their hands and they are going to rue the day, or a lot of them are going to rue the day because it's just too difficult trying to pick where the bottom is. And as you saw from that analysis earlier, Wellington City, of all places in the lower North Island, looks to be the least susceptible to deep price falls from here. Happy to indeed use this time now to have a chat in amongst the group. So who wants to just unmute yourself and fire away?
Okay, I'm just wondering if you think the government's going to be tweaking the Triple Cfa rules anytime soon.
Yeah, I'm not a mortgage broker and I'm not in that finance industry, but I understand from talking to people who are that they have tweaked them and that they're coming. The changes are coming live in July, but most of the banks, firstly, most of the banks have already kind of implemented those changes in anticipation, and they have relaxed to a degree, and so there is a little more money flowing, but the changes are not big changes. The other thing, of course, is that even if the rules didn't change, when new rules come in that are onerous or that are hard work for people, it takes time for people to get used to those rules and to I suppose to deal with them and to learn how to deal with them. So even if they didn't make any changes, after a period of time, buyers would be prepared for those new conditions, and they'd get their finances more in order. They'd cancel those Netflix subscriptions. They'd stop getting Uber Eats every night, the money would start to flow a bit better just on that for those reasons. But yeah, I think I understand the banks have started to relax the conditions a bit, and money is flowing a little bit better, but the changes that are being made are not massive. If there's anyone on here that is in the finance industry, by all means jump in.
And so a comment that another real estate agent had made to me is that, with the Triple Cfa taking out the finance availability at the lower end, the first home buyers are just not there. Yep. And so that's bleeding out. There's no trickle up where the earlier first home buyers are then buying their second home, and so on and so on. Is that your experience?
Yeah, that is. And if you follow the CoreLogic data releases, every month they do an analysis of who have been the buyers in the market, what proportion of the buyers are first home buyers, what are foreigners, what are what do they call it, movers, I think they call it, where you're moving from one house to another. What are investors with a mortgage and investors without a mortgage. And investors without a mortgage just means no mortgage on the property they're purchasing. Doesn't mean they haven't borrowed money to buy it from somewhere else. But so obviously we've seen the number of transactions taking place has reduced significantly by 30–40%. And the proportion of those transactions going to first home buyers has also reduced. So not only is the pie a smaller pie, the slice going to first home buyers has reduced. So the market share is being absorbed, I believe, by the movers, people who've got a property and are now seeing, oh gosh, it's easier for me to. It was like really high pressure before. Gosh, I could sell and I have to buy, and it all has to happen so fast, and it's high pressure. Now it's way sort of a slower, more considered process. You can buy subject to sale, all these things. So the market share that's going to movers has increased by the most, I believe, but the biggest change in the opposite direction is from the first home buyers. So that's a big reduction in the number of transactions going to first home buyers, because the overall quantum has reduced, and the share going to the first home buyers of that has reduced as well. So yes, certainly it's the first home buyers that have been crushed the most. And I have heard sort of anecdotal evidence, people saying that, in the $5 million market, that hasn't really changed much, but that's such a tiny segment anyway. That's people who don't need mortgages. They're not impacted by mortgage interest rates, that sort of thing. And you're absolutely right. The first home buyers, if they're crushed, if they're not buying their first homes, the people who are selling the first homes can't buy the second home. So it's definitely an interconnected market. And yes, I would suggest that the first home sort of segment of the market has been one segment that's been crushed the most. The other one, of course, is the investor product. So a three or a four flat purpose-built building, one title, it's only ever going to be rented. It's only ever going to be an investor that's bought it. These things are really suffering. I've seen extremely good quality multi-flat properties in fantastic, like seriously good locations, right on the fringe of the city, purpose-built or completely rebuilt and renovated, you know, beautiful condition, fabulous properties, selling at sort of 6.5% through to 7.5% yields. Pretty remarkable. Phil, you've said, do you think the change differs over property type? Yes, it does. Like what we've just talked about would be the most obvious ones. I mean, things like, I don't know, like a suburban flat, a flat in Wilton or a flat in Haitaita or Island Bay or something. These properties saw massive increases in demand, massive increases in prices as first home buyers got crushed out of the market for properties that they would ideally prefer because they couldn't afford the 2-bedroom renovated cottage in Newtown anymore because they weren't 400,000, they were now $1 million. And so they went and bought, you know, a 70 square meter flat in Haitaita instead, and they were paying 700,000, 800,000 for those. But when the market was slow last time, those properties were seriously difficult to shift. And so those properties that are more fringe type properties, I suspect they are more susceptible to slowing down for a bigger price correction. But equally becoming it much more difficult to sell without, you know, really taking a bit of a haircut on the price. Because for the most part, historically at least, if a buyer wants to buy an apartment, they don't want to buy an apartment and live in the suburbs. They want to buy an apartment because they want this convenience of city living. They don't want a garden, they don't have children or pets, that sort of thing, but they want to be able to walk everywhere in the city. So the demand typically or tends to drop right off for the, you know, for the 1-bedroom flat in Island Bay, or I'm not picking on Island Bay, but you get the point. So the most defensive investment in the real estate market is, you know, your 3-bedroom, 120 square meter, 1.5 bathroom, single garage, fence with a backyard, in between the school, the shops, the beach, and the city and the airport. Those things are always going to enjoy demand from normal families. The smaller segments will always be a bit patchier. Peter, you've said demand for rentals has pulled back for property in Upper Hutt and rent amounts have tweaked downwards over the last 2 weeks. I have noticed the same in Wellington City also. I mean, I personally had a 5-bedroom, 2-bathroom flat on Adelaide Road with another flat down below it. That had been rented to the same group of tenants for 4 years or something like that. It was really scruffy. It was rented for $11.75 up to February. Because it was so scruffy, we ran in, we put new carpet, new paint, new light fittings throughout, like a total cosmetic redecoration, renovation, not kitchens and bathrooms, attending to any repairs that needed to be done. It was like 25, 30,000 overall. And then the thing sat empty for 8 weeks while we tried to find a tenant. We eventually found tenants, and the rent went from $11.75 to $1,100 after we'd completely refurbished the interior. So, I mean, partly that was winter. By the time we rented it, it was winter, and it's a 5-bedroom place. It's really third-year students sort of thing, or first job out of university. Not the right season to rent those things, but nonetheless, I've had other feedback too, and I'm closely involved in our property management business, and yes, certainly there is some softness in the rents. There's a large number of listings for properties available to rent. So yeah, it's going to be interesting. We're seeing a lot of young people leaving the country, going on their OE, going to work in Australia or whatever the case might be. Most of these people are rent. That's a lot of tenants leaving, and we don't have a whole lot of immigration pouring in across the border as a whole lot of most people were expecting. So interesting times. Yeah, Jeff. Yes, you came in rather late, but for sales volumes and duration to sell, how far back in time do we need to go back to see similar numbers? A long way back. Let me see if I can go back to those. So you can see there, sales volumes have dropped right off the red line there. That's 6-month moving average. Come rate, very, very unusual for it down to be below 600. The only other time we've seen below 600 is when we had the 6-month incorporating lockdown. Typically it's between 600 and 800. Yeah, I don't know how far we have to go back, but further than when I started collecting the data. So it's very unusual, very, very unusual. I mean, I would suggest to you that these are, you know, barring extreme, I don't know, calamitous events, this would be the toughest kind of landscape that I can imagine, really. I would imagine that with people getting their arms around finance, as what will happen, I suspect, is vendors will just say, I'm not selling. So that really reinforces, puts a floor under how far prices can drop, because people aren't losing their jobs. We have a really stable employment here in Wellington compared to most other locations, because we've got so much employment engaged in government or quasi-government, and so the workforce is more stable, incomes are high, unemployment is very low. You know, vendors will just say, well, that's it, I'll just keep it and stay here, or I will carry on and I'll go overseas to my new job or whatever, and I'll rent the house. So as buyers see the price falls be arrested and plateau, then that will encourage buyers to come back in. The sky hasn't fallen, prices aren't going down anymore, I can safely get back in without losing my shirt or without losing my equity. And so I suspect that's what will happen. I don't think it's going to get tougher from here. Prices aren't going to go up, I don't believe, and prices will fall a bit further, whether it's 2% more or 4 or 6 or 8. 10%, wow, I'd be surprised. But so I think conditions are going to get a bit better from here. Your other question was about duration to sell. So yeah, you can see there that it's very unusual to have things taking this long to sell. Yeah, very unusual indeed. So I would suspect that, you know, we'll see things carry on like this, and then it will come down a bit, but prices won't necessarily rise. It will just be a stabilization of the market and an acceptance of the new normal, and the wheels will be lubricated and will move a bit more as the market understands what the new normal is. I mean, that's what I suspect will happen anyway. Hope that helps, Jeff. Phil, do you have a prediction of the end result of escalating build costs and lowering property? Yeah, that's an interesting question, because of course what you got build prices going up, end values coming down. At some point, that number goes the other way, right? And so we've had, what, 50,000 building consents approved in the last 12 months, 55,000. We're going to start to see these building consents rapidly getting shelved as people realize, gee, the value of my property has fallen by 100,000. The cost of doing this extension has increased by 50,000. It's no longer worth it. Let alone the pain and the stress of the delays, the lack of building materials, managing tradespeople who are flying from one building site to the next because there's so much demand at the moment. So yeah, I mean, I think we will continue to see builders who are who have not been great at managing their their inputs and their contracts on pricing and all that sort of thing. They'll continue to, we'll see more failures in that space, and same with developers. I mean, who does a developer sell to now? Who does a developer whose business model is selling off the plan, who do they sell to now? Because typically their markets were first home buyers and speculators, or speculators buy these things because the value of real estate's going up, and so they'll sell it in 12 months time, 18 months time, and make $100,000 without even settling on the thing, or do a contemporaneous settlement when the property is finished. So speculators, they've disappeared. Prices are falling, not going up. And first home buyers, well, I don't know many first home buyers who prefer to buy a property they can't see, feel, smell, touch, walk into, look at the view from, see where the sun falls, see how big that room really is once you're in it, as opposed to looking on a plan, because most people can't visualize these things. So first home buyers don't want to buy a property off the plan. They've bought properties off the plan because they find it so difficult to compete with tenders and auctions and properties that are already finished. And every time they do that, it costs them $2,000 or whatever. And so they just give up. It's too hard. And so they just take a red sticker and they stick it on the townhouse and go, that one's mine. And they're a fixed price, and their problem's solved. Well, that's a different landscape than what we're in now. You've got plenty to choose from now. And so those developers whose business model is selling property off plan, well, they're going to have to reinvent the way they do business. So I think it's going to be interesting times. It's yeah, interesting for everyone. If you're selling, it's certainly a lot tougher to attract the attention of buyers. There's a lot more to choose from out there. You have to put your property in flashing lights to get attention. Properties will still sell when they're marketed well, when they're priced properly, and when the buyers are aggressively pursued. But it's certainly a different landscape from 12 months ago. You just sort of stick it on the market, stick it on Trade Me, and sit back and take the order. I think I'll say farewell now. If you got any questions and anything else, just reach out. Happy to talk. Thanks for being here. Thanks for all your questions, everyone. Very, very interesting times. Have a good evening and stay warm out there.